We're gonna record.
Perfect.
Take it away.
Okay, Richard, over to you.
Okay. Can everyone hear me okay?
Yep.
Yep. All right. Awesome. So yeah, little introduction. So my name is Richard. I work at AWS on the startup business development team. I've been at Amazon now for 6 years, which is a really, really long time. Before that, I worked at a bunch of startups, Uber, Redify, Teespring. I did my own. We went through Techstars back in 2014, raised a seed round. And then in the last little while, I always say the last 18 months, but I've been saying that for about 18 months. So realistically, it's the last 3 years. I've been doing a little bit of angel investing. And so have invested in around 10 or 11-ish companies now. And so have seen everything from the perspective of, companies with a lot of traction, companies with no traction and just a product, company with not really a product yet. In that role as AWS, but also angel investor, I've probably seen, I don't know, well in excess of like 500 companies, pitch decks or like investor memos or whatever. So pretty familiar with the stuff that you guys are working towards right now. And so I was thinking about this talk, and I didn't know whether I should put together a presentation or whether I should do mostly Q&A. And to be honest with you, I wanted to do mostly Q&A because numbers are a very personal thing to your business, right? You are going to have, how many people have we got on the call? We've got 52 people on the call. And you guys are all going to have questions about your specific company. You're going to say, oh, that question kind of relates to me, but actually my company does something slightly different. How does it matter for this company? B2B versus B2C, or versus enterprise, or B2B2C. And so numbers are so specific to your company. I wanted to open it up a little bit more than that, but I will dive in a little bit. And so I think we're talking mostly, again, I'm going to go off the basis of what Purdy and MA asked for me, talking mostly about revenue numbers. And if you don't have revenue numbers, what do you need to have to, Christina's got a question already. Amazing. What you need to have to show that you've got some traction. Ultimately, let's start with traction. Okay. Do you need traction to raise money? The answer typically is yes. And specifically in this kind of market, we are in for anybody that hasn't realized that we're in a down market, we're in a bear market. The bar for raising money is much higher now than it was, even if you had raised it at November last year. So we're talking under a year ago. If you had raised, if you were looking to raise money in November last year, your traction could have been minimal and you probably would have got a check. Now the bar has been raised. Investors still have money. The dry powder is there. But their bar for investing in you is significantly higher than it was. And so I would say that unless you have a previous exit, a decent exit under your belt, or you guys as a team are just so unbelievably amazing that maybe, I don't know, you've all worked really early on at top-notch startups that are now, mega decacorns, then the chances are you're probably going to need traction. And so traction is going to mean different things, right? If you are pre-revenue, you're going to say, well, what does traction look like for me? So pre-revenue, talking about a B2B business, you're going to be talking about letters of intent, proof of concepts, what your pipeline, what your funnel looks like. And I see some questions popping up already. I'm going to come to them in 2 seconds. And if you are got revenue as a kind of B2B business, then it is going to be, what's your MRR? What does that look like in ARR? What is your churn? What are your NPS? How fast is it growing, right? Because growth matters a lot. If you are 100, even, a big thing of a big number, $100,000 a month in MRR, but it's not growing, you're just static, then that is not necessarily as interesting to investors as somebody who's at 15K MRR, but growing 25% month on month, because they see the growth and they see what that means. Maybe at 100K MRR, you've hit the ceiling of your product, which is, like you can build a great lifestyle business, earning 1.2 million pounds a year, but that is not necessarily an investable business. And so, yes, your numbers matter, but also your growth rate matters, your churn matters, things like that. The The other numbers to bear in mind when you're thinking about your pitch deck, you're thinking about pitching, is your TAM, your total addressable market. I've been in this business, the startup world, for like a long time. It used to only be TAM, and now it's TAM, SAM, and SOM. I'm not going to lie, I don't really know what SAM and SOM mean. I don't necessarily care. I feel like it's buzzwords that have popped up in the last year. What really matters is how big is the market and how fast is it, again, and how fast is it growing, okay? Investors love to invest in fast-growing markets. So, for example, you could say, my market addresses, petrol stations, okay? Petrol stations are, I don't know, in the UK, $10 billion a year business. Are they growing? No, because the electric car is taking off and off and off, right? So it is $10 billion a year business that's going to be decreasing by, say, 3% a year from now, and it's good that decrease is going to speed up. And so from a venture scale business, not necessarily investable. But if you're investing in electric cars, on the other hand, much smaller to begin with, but the growth rate is humongous. And so, again, the size of the market, obviously, but you don't want a tiny $100,000 market globally. But again, if it's, 200 million versus 2 billion, the growth rate of that market really matters. And what I would say, the thing about the SOM number that gets me is, we used to tell people never, ever to put if I only could get 1% of this market, my company would be X big. And the reason not to do that is, number one, investors can do the maths. And number two, it's really, 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 really hard to get just 1% of a huge market. Okay. And talking about, I could get 1%, the number this big. Well, it's, you're not talking about how hard it is to get 1%. And so that's why I kind of denigrate this number. But yeah, what I'm going to do now, that's kind of like very high level. I'm going to dive into these questions because they're already popping up, and then I guarantee you we'll smack through an hour. All right. Define traction, we're kind of doing that. What's an exit? Exit is when you sell your business. Okay, so that is either when you sell your business or when you IPO. Ultimately, that is how investors make money, because what that does is that gives them liquidity back. And so if you are a venture investor, an angel investor, or whatever, the only way you make money is when that business sells, either to another company or to the public in an IPO. And so that is what we think of as an exit. MRR, monthly current revenue. Churn is how many of your customers are leaving. So say you are growing, maybe you've got, 50 customers on your platform. It's growing 10% month over month, but your churn is 20% month over month. Well, soon enough, you're going to have no customers if you don't figure out your churn. Maybe you've got a great first pitch, a great onboarding memo, but for some reason the product isn't there and your customers are churning. So that's also what investors will look like. What about for B2C? So for B2C, it's completely different. This market, B2C in this market is going to be harder, but what people are looking at for your DAUs, your MAUs, your churn, anything which shows significant engagement. And it has to be really high. I've turned down the opportunity to invest in companies that have, 10,000 MAUs, because I just don't, 10,000 in the grand scheme of consumer is just not big. And to get genuine revenues through advertising, which is how B2C companies make their money, you need millions, like literally millions. And so B2C is very, very hard. I think what you need to do is you need to show a decent base of early users who are using it often, like a lot. Whatever your app, maybe it's a social app, maybe it's a, I'll give you an example from my background. So I invented in a company called Dishbatch, which sells meal kits, like restaurant meal kits. They went through Entrepreneur First. I invested in them really, I think, before they kicked off, because Entrepreneur First is very, very early on. They are B2C, but I liked their model, and it's not like a social media app. They don't rely on advertising. They sell subscription meal kits. They were at one point the fastest growing company in the history of Entrepreneur First. That is not me telling you that I'm a really good investor, because I'm not. I have no idea. It's just like being in a B2C company that's successful, you will grow much, much, much faster than your peers in B2B. But monetizing that profitably is much harder because people are stingy, which is why nobody pays for Facebook, nobody pays for Twitter, nobody pays for LinkedIn. The advertisers do. And so depending on what kind of B2C you're building, in Metali, if you put your hand up, we can jump to it. Is going to depend on what kind of numbers you need. How does Warren explain churn when we are pre-revenue and asking for investment while during our beta launch? If you are pre-revenue, I'm assuming you're a pre-customer, which means you probably shouldn't have any churn. If you do have churn at that very, very early stage, then you're not focused on the right customer, would be my guess. Key traction for pre-revenue B2C is a waitlist is enough on the B2C, depending on the size of your waitlist and the fact that you have it focused. So I did an interview, podcast interview with Johnny Bufferhat, who's the CEO of Hopin, if you know Hopin, and they had a humongous waitlist. Also did one with what's his name? I think it's Rahul Vora, who's the CEO of Superhuman, and they also have a humongous waitlist. The difference being that they have both at points culled significant numbers from their waitlist. And so, investors having to kind of taken in those lessons will be like, all right, you've got 10,000 people signed up for your waitlist. How many people are actually going to use it? And how many people are you letting use it? And those people that you are letting use it, how many of them are actively using it on a daily or monthly use basis? And so it's good to have a waitlist, but it doesn't necessarily show me anything other than you might be quite good at marketing, because I'm going to assume that at least 40 to 50% of that waitlist aren't going to become your end customers. And what I need to know is how good you are at whittling it down to who your end customers are going to be. And then how much they spend on it, whether it's money, whether, it's a subscription type deal, or whether it's a social app, how much time are they spending on it? All right.
There was a question right at the start of the session from Ati and said, can you define traction? Does that mean engagement on social, selling, or both?
Selling, only selling. Like engagement on your Twitter or your Instagram feed does not matter unless you are selling me an Instagram account. Because that does not mean somebody that is going to pay for your product. Like what traction means is customers. Okay. That is people who are paying for your product, or that is people who are likely to at some point pay for your product, whether you have a letter of intent from them, whether you've got an agreement to do a proof of concept. Traction is only, I could get bots to like 1 million of my tweets. And my tweets are great, let me tell you. Purdy follows me. I think Spice, I don't know if Margaret Ann follows me, but
hey, I followed and like some of the tweets. You've got high engagement.
All right. But if I wanted to, I could pay whatever to get 10,000 likes and retweets for my tweets. It does not mean a single thing, right? What matters is if I am selling something, is somebody buying it? That is what traction is. Cool. I've seen an exit strategy on the pitch deck. Okay or not okay? I would say no, purely for the reason that it makes me think you're not in it to build a long-term business. And really, look, if you're already thinking about exits in year one, then I'm like, how dedicated is this person when it's going to get really shit? And let me tell you, it is going to get really hard. It is not easy. It is very hard to build a startup. It sucks for most of the time. Even when things go well, you have 10 things that are also, not going well. And so if you're already thinking, like, I understand from your perspective that you're not thinking of that. It's like, these are just, I'm being strategic. These are people who might want to acquire my company at some point. But again, if I'm a professional investor, I know the kind of buyers for your business. And the other, and it's a bit of a distraction, right? Because right now there's a lot of antitrust engagement around big tech buying even smaller companies. And so if you put, Amazon, Facebook, and Google on there, then you might get mired in a whole conversation about how those aren't actually proper acquirers for your business because they're not allowed to buy companies anymore. I mean, Facebook are being stopped by like a small like fitness company for like $60 million or something like that, which is, which is going to be a great outcome for the founders probably, but in the terms of the size of Facebook, it's tiny. And in terms of the size of their other acquisitions, it's tiny. They bought WhatsApp for $19 billion and they're getting stopped. And that was fine. That was wave through. And they're going to get stopped on a $60 million acquisition of a like small fitness company. And so there's a lot more government oversight right now. So from that perspective, I wouldn't put it on. And also from the perspective, it doesn't make me think that you're super long term. Can you say more about churn? What if your product needs modified? Yeah, it probably does mean your product needs modified. Like your product is a living organism, right? Even when you have raised your series B and C and D, your product is still going to change. Okay, so obviously at the early stage, your product doesn't need to be modified. And it's going to continue to be modified throughout its life. You're going to add features. And so you can talk about reasons for churn. And, this person left because they really cared about feature X, which we are building, which is on our roadmap to build in 12 months to 18 months or whatever. But it's also going to be hard to win them back, just, recognizing that fact. You can talk about it. But I think, if I'm honest, what you should do is focus on the customers who will actually really want to use your product as it currently is. Like, because ultimately, as an investor, what matters to me is you are solving a problem. If you are solving a real problem, even if you do it in a shitty way, technologically, you're going to have people want to use it, and your churn is going to be relatively low. And I'll give you an example. I think I've given this in previous talks with cohorts. There was a company that went through Techstars a couple of years ago. It was called Pesky Fish. They helped fishermen sell the fish whilst it was basically just caught. It was still on the boat. And they helped restaurants buy the freshest fish because they were selling it once it had literally just been landed on the boat. Their product was WhatsApp and Google Spreadsheets. Okay. And the reason that they were able to get funding was not because they had an amazing product. It was because they solved a problem. They did it in a scrappy way. And, investors can see that the product is going to evolve, but they did it in a scrappy way because they were solving a real problem. And so they didn't really have much churn because they focused very closely on the primary use case, who they were solving a problem for, and how to get them on board. And so, they're going to have an app later on and a database and all that stuff. But right now they've got WhatsApp and they've got a spreadsheet, but they have traction in terms of sales. They have traction in terms of customers growing, and their churn is tiny because they're actually solving a problem. So if you are signing up customers with false promises, if you are signing them up with what the product is going to look like in a year, yes, you're going to have high churn. And yes, it's going to be harder for you to win those customers back in the year or the 18 months when you've actually built the product or built the feature that they wanted. And so what I would do is I would focus on finding a small cohort of users who feel the pain more than others and solve their problem, even as if it is in a scrappy way. And then you will have traction and you will have low churn.
Should we go to a live question?
Sure. I mean, look, there's a lot of questions in the chat now, but let's go to a live question to anybody. Should we do Jody?
We'll do Jody and then go back to a few questions from the chat. Okay, Jody.
Okay, so my thing is that the two-sided marketplace is very difficult to get both sides. So we've created a CRM for farmers who sell direct to consumer. And okay. I have a strong cohort of farmers who've been working with me. They're committed, even though the product didn't work for them, they're sticking around, recommitted. And then, but it's hard. I'm bootstrapped. I don't have help to get this off the ground. So product development's slow, marketing is slow. And what do you do? I mean, I've got a lot of validation and the market's huge, $70 billion market US. But I need to get over this. I can't, it's getting from point A to point B is difficult, this early stage.
So tell me, what is it that's the most difficult? Is it, so you say you've got a lot of farmers on board, so you've got the supply side of your marketplace.
So, yeah.
And so what you don't have is the demand side.
Well, because they have to activate. So it's a community for to engage their customers. They have churn because we're solving a retention problem.
Okay.
And and it's not, our product isn't easy to use for them. It's not obvious how to use it. So there's some education has to go in. They want the outcome, but they don't, we have to teach them how to use it and make it a little bit less clunky. So that's
just so I understand, for the buyers, you need to make it less clunky for the buyers.
Right.
Okay.
Which would be the farmer.
Oh, sorry. I thought the farmer. Sorry, I'm confused. I thought the farmer was the supply of the marketplace. So like.
No, so it's the farmer and the farmers markets to engage and retain their customers.
With the consumers that come along on the day.
Right.
Okay.
Or subscribe, because there's a subscription model to a lot of farms. So. Okay. Yeah.
And so does that mean that on the day you're kind of asking those consumers for their email address or their phone number, that kind of thing?
They follow them on our community. So it's yeah. And the problem is we created a barrier by having mobile first, not because the farmers don't have good access to mobile on their farm. Okay. So we're stuck. Yeah.
Yeah. I mean, like, so I'm just let me try and think a second. And so you have churn because
actually I don't have churn. I just don't have activity. Like they're sticking. Activity. I mean, they've even re-upped. I'm like, are you guys, should I like did a breakup email? And they're like, no, we want this.
Okay. All right. So you don't have churn. You have activity on the farmer and the farmer's market side.
Yeah.
And what you're not having necessarily is activity with the kind of the end customers. And so it's like, how do you engage that B2C, that consumer side of the marketplace?
Actually, yeah. I know what to do. I just need help doing it. It's just me and a part-time developer. So I need funding so I can get this off the ground.
Yeah. So, I mean, you get the funding side there, but I hate to say it, I would try and do cheap stunts that can get you access to a lot of people. Or, I mean, so do you have enough people signed up, or is it they're just not being active? You do, but they're not being active, or you don't have enough people signed up in the first place?
We're really early. So we have 10 farmers who signed up to pay. We have 30 that signed up as free users. And then we have 1,700 customers who have just downloaded the app.
Okay.
Now we need to get them going.
Yeah. I mean, so.
And then grow.
Yeah. So I think this is more like a marketing question than like than a traction question, right? It's like, how do we get our customers to engage with the product? And unfortunately, like the only answer really there is create a compelling reason for them to do so. So like at the moment, what reason do the consumers have to engage with the product?
They can figure out how to use the products that they buy from the farmer. Like that's the reason they churn. So they're buying from farmers. People want to buy local ingredients. That's a trend. It's a huge trend.
Yeah.
But when they do that, they don't know how to use those ingredients, so then they churn from the farmer. And that's we're hoping to solve that problem.
Okay. So maybe you could do some of that, I think in the chats, but about offers or discounts. Oh, sorry, 1 second. Which is definitely a possibility. The other thing to do is really figure out, I mean, I would talk to your users. Like that's the thing.
Yeah.
If you've got your farmers on board, you've got 1,700, you said, downloads. You need to talk to your users and find out, you got a startup as a hypothesis, right? You have a hypothesis of a business that you want to create and a problem that you think needs solving. In order to prove the hypothesis, you need to speak to your users and make sure that is what they want. And if you speak to 1,700 people and you're like, oh, I thought X, and this happens to every business, right? I thought X, but it's actually Y that you're using the product. Well, then you'll know how to engage them. The other thing you can do is relatively cheap things. So I'll give you an example. There was a company in the UK quite a few years ago called Dojo, which was a B2C app. What they did and they got thousands and thousands of downloads, was they wrote their life story on a piece of paper and they just printed out thousands of them and then handed them out to people. And it was like, I'm Richard, I work at Dojo. This is what Dojo does. I've left my high-flying job at X, Y, and Z company to found this. And I'd love to see, if you have it. And they just handed it out and they got, tens of thousands of downloads. But ultimately, I think you need to speak to the end user or the people that you think are the end user to find out exactly what they want from your product and what would get them to engage. Because this sounds like almost like a customer discovery problem, right? Which is, I've given you this and you aren't using it like I thought you would. And therefore, why? And it's, and be kind of open and vulnerable and just be like, if I'm connecting you to this farmer in the farmer market, what is the most valuable thing that you can get from them?
Mm-hmm.
How can I help you?
Thank you. I did that this summer. I stood at 4 farmers markets.
Okay.
And I got some great data. The season's over. So now I'm trying to get myself ready to launch because I kind of know, I do know what we need to do and what the gap is.
I'm just gonna jump in because we've got a lot of questions to go through. But Jody, we have the peer-to-peer session afterwards.
Okay. Thank you.
So let's go to Mitali. I saw that you had some questions in the chat too, so I think you'll probably cover this.
Brilliant. Hi, Richard. My name's Mitali.
Hey.
Thank you so much for this time today. So you're going to laugh because I'm B2C and I'm advertising. So I've given myself the hardest possible task, but I feel pretty confident. So I've used my pre-seed money to build a platform, and it's a music events platform for DJs and fans of dance music. Well, that's the first market we're going for. So I'm B2B in the sense that I'm selling to DJs, but then the end customer are ravers. And so the problem we're solving is that when you watch music events online, it's very much a lonely experience because it's like a TV with a chat box. And so what you're lacking is that togetherness, that feeling of human togetherness, and that's what my business Castrums is here to solve. So where I'm at is that we have built a platform. It's not. I wouldn't call it an MVP because it's not ready to commercialize yet. But what we're going to have is a show reel of people having a fantastic time in the product. We've done tons of research. So we've interviewed over 40 DJs, plenty of market research. So we're really confident that we've got the product market fit right and solving the right problems. But obviously when trying to build trying to show 1 million users, it's going to take a lot of money. So I guess my question is that I've got a runway until January or February. By which time I'll be able to have maybe 20 test parties under my belt. So I'll have fantastic data, but it's not traction data in the sense that you've described as, lots of people logging in. I could probably say that people would say they'd come back and use it again. But in order to do my seed raise, I need 1.2 million in my seed raise to get me to Series A. So what can I credibly do to get a valuation of 6 million?
Ask the easy questions, eh? I think, again, it's not a market that I'm familiar with. I think if you said you've done a lot of research, you've spoken to 40 DJs, they're excited about the product, can you promote via them to get more people utilizing the platform, right? And so what is the highest leverage thing that you can do to acquire users for cheap? And if you are working with people who already have a built-in social following, that is the best thing you can do. Well,
I've got Kerry Chandler, who was one of the biggest house music teachers.
It goes right over my head. I'm afraid it's just.
No, I know. But
if it is not 90s and early 2000s hip hop, I've not heard of it.
I've got some really big DJs. So
awesome, and I'm assuming they have big Instagram followings and big Twitter followings and big, probably random house music platform followings as well.
So we're planning to seed the platform by paying influencer DJs essentially initially. I just wondered what you thought about that idea as well.
I mean, pay to play can work. Depends how much you want to use up of your runway to do that. If you can, try and find some true believers who will do it for free because they believe in you guys and the product. Obviously easier said than done. But if you're going to try and utilize their massive social following and you're going to get them to be on the platform anyway, it might be exciting for them to get going there. It's not a sustainable long-term strategy is what I would say.
Right, yeah.
And so you can use it to seed user growth in the beginning, but you have to figure out really what your long-term customer acquisition strategy is.
I mean, that's all modeled 5 years out. Everything is modeled like so, but it's what my challenge is am I better off in order to get to show the traction, just to get a loan, just to get us to the point where I can show a show reel of loads of people having fun, loads of people, loads of DJs saying that they'll use it, or can I just be really bullish in this bear market and say, listen, I need 1.2 on a valuation of 6, or what do you think my chances are?
I mean, look, if you can get some traction to get that number, go for it. And like everything is up in the air, and all you need is like one investor to back. This market is very hard to figure out what people are going to raise and what valuation. I have companies that I've invested in who are looking for bridge rounds, and they're good businesses, and they are taking in, they're not B2C, but they're taking in a humongous amount of MRR, and nobody wants to touch them. And then I see other businesses with very little traction raise some stupid number, right? And so if you can get some, like, I couldn't tell you now what you need to do to raise 1.2 million in February, because I have no idea what February is going to be like, and B, I don't know how good you are at making somebody believe in your vision. That's ultimately what you need to do. Having traction helps them believe in that vision, and maybe that traction comes via the DJs. Maybe it comes via you paying some of the DJs to promote for you. Maybe it comes from organic traction. What I would say is, don't only focus on the near term, focus on what is going to be kind of high leverage opportunities for you going forward. But it's a tough one, but maybe the best thing to do is utilize your runway slowly, so you give yourself the best opportunity to survive, right? Yeah. Try a couple of different things. Don't spend a humongous amount of money on one thing. Yeah. Let stretch your runway as much as you possibly can until you find that couple of customer acquisition strategies which are going to blow the roof off.
Okay, thank you.
We have a good question in the chat from Christina. I've been told I'm not showing to investors the financial opportunity, or I'm not displaying that enough in the deck. What type of slides really wowed you when looking at the go-to-market and potential revenues in a pitch deck?
So I'm a bad person to ask this question to, because I think that the 5-year financial plan is bullshit and nonsense, and is fairy dust, and who cares, right? Like, either you're going to be dead in 5 years, or you're going to be so far exceeding what you had planned that you are, a mega $100 million company, right? And you could never possibly say with any confidence, oh, this is my cost of sales in 5 years' time if I have X number. It's just not possible. But investors who are not me, and particularly those with a financial background, which is the majority of them, at least in Europe. So maybe they come from banking, maybe they come from accounting, maybe they come from consulting, do like to see those numbers. And I think they just like to look that you've done the work. They're never going to hold you to it. They're never going to be like, oh, you said, maybe in year 3, you said, oh, you said you'd be spending this, but actually in year 3, it's this. I mean, nobody cares. But people like to see that you've done the work. If you are not showing the opportunity enough, it's very possible that you are being too conservative with your potential growth, right? If you believe this is an actual, just to talk plainly here, let's talk about how investors make money, okay? So investors make money in two, and I'm talking about institutional investors here, okay? Forget angel investors for a minute. Let's talk about venture capital funds. Venture capital funds make money in 2 ways, okay? They all raise external money, and then they charge for that. So say, you have a seed fund that raises $100 million from, pension funds and endowments and high net worth individuals. They then charge what's called 2 and 20. That is 2% operating costs. So that's 2% a year on that 100 million, which means that venture fund takes in $2 million a year. That pays salaries, pays office expenses, it pays traveling expenses, pays overhead. And then the 20 is they get 20% of carry. That is 20% of the profits. So when you return money to the fund. Now, the 2% isn't forever, right? So their salary is not paid. Their 2%, it'll be 2%, it'll be in their docs. 2% might be for 4 years. Then it goes down to 1.5% and then down to 1 year, 1%. That is why you see investors raising new funds every 4 or 5 years, because they're topping up their money and their salary. So what they need to do in order to raise more money is they need to show their current investments are 10x or 3x or 5x or whatever when they invested in them, right? So they need to have investments that look like they are really successful, because most likely they won't have, their most successful investments will not have exited by the time they're raising new money. So they need to say, oh, we've marked up these 5 investments 10x because that's what their latest investor has invested them at. These, 3 and 4 investments have gone away, and these ones are kind of sidling away over there, right? And so, like, when they're raising new money, most of the companies from the previous fund that are at least looking to be successful won't have exited yet, but they need to have marked up. When they do exit, that's when the investor takes their 20% profit. And so if you are a venture investable business, you need to be able to at least return the fund. And so for a $100 million fund, if they own 20% of that, that means you need to have an exit of $500 million. Okay, that is not a small feat. So if the investor says that you are not showing me the opportunity enough, that means that they don't think you're a venture investable business, because you are not going to help them raise more money in their next fund, and you are not going to get them any money when you finally exit and they get their 20%. So it's possible that whatever business that you're building just isn't that, in which case find other ways to fund it. There are debt, there are bank loans, there is, friends and family who aren't looking for that kind of return. There's what's the name of the company that gives you loans? Funding Circle, or whatever. Build a lifestyle. And by the way, this is no dint or ding on you as an entrepreneur. There are plenty of very, 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 very wealthy entrepreneurs who did not build venture investable businesses. They owned 90% of the business themselves, and they built a $10 million a year, revenue business selling garden gnomes or whatever the hell. And they're super happy and they're super rich, and they're much happier than people building startups who need to hit venture returns. But if you want to build that kind of business, that's amazing. Do that. Be an entrepreneur, build that. But it's also potentially not, you have to realize that it might not be venture return sized. Now, if you want to build a venture return sized business, you need to be able to show how your business can get to that $500 million exit potentially. Okay. And so again, without looking at your deck and saying, oh, you've done X, Y, and Z, that's what you need to think about. You need to understand the investor psychology here. Okay. They think how they're going to make money, and they're going to make money by raising new funds and taking their 20% when you sell. And for them, that means you need to be markupable. And then when you sell, you need to be, returning the fund at least. Hopefully that kind of covers that and a bit extra.
Thanks so much for explaining that. That's really, really useful. Good question from Rebecca in the chat, and then we'll go to another person who has their hand raised. So Rebecca asked, what if the startup is a diversification and the original product is successful, but the investment required is for marketing the new approach? Example, the original product is an in-person training, and then the startup that they want to raise is an e-learning program. How do you use the past traction you had to fuel your future investment, inspire investors, etc.?
Yeah, I think it's useful in that it shows that you know what you're doing, you know the market of which you speak, but it would make me, and this is just personal, all of this stuff is my personal opinion, anything make me nervous that it's not necessarily the same thing, right? This person can do education, they can do in-person training, and they get a budget, or they can get people coming to that. But I'd be nervous about, what do you know about building a tech platform? What do you know about servicing users in that way? Do you have an engineering background? You've got a product development background, a design background, all different kind of skills. And then again, can you scale up? For your in-person training is really 1 to 20, 1 to 30, whatever. An online education platform needs to be for it to be successful, realistically, it needs to be like 1 to millions, right? Maybe you're doing something around learning new languages, right? So you look at Duolingo, they have millions, if not tens of millions of downloads. There's the other one, I can't remember, like where they can do like online courses. Again, you're looking at, you know, hundreds of thousands, if not millions of users, but their courses are quite expensive. So, you know, you have to prove that you have this other set of skills, which matters for development of a software business and an investable software business as well. It's great that you can like, okay, I got it. You can do the training, but this other stuff is maybe outside your realm. So where's that coming from? Do you have the team assembled to build that? And how are you going to scale that?
All right, thank you. Okay, Pulami, over to you, and keep your question to 2 to 3 sentences.
2 to 3 sentences, okay. So I'm Pulami, I'm based in London, and I'm in a catch-22 situation. I kind of raised 67K USD in angel from abroad, but then only 44K, let's say, entered the bank account. And ideally I should have raised 100 to 100K. So in that, I mean, we got like 1,000 manufacturers. So it's a crunch-based sort of a thing for ethical manufacturers, where we sort of help brands to connect and source ethically and find out about the manufacturers. So in that, we kind of did verification of 1,000, and we released MVP, which has a lot of bugs, and we want to work on that. Money is running out. So we have money like run till November, I would say, or December max to max if we stretch it. So I'm looking for some money right now, like some in angel, like say around 50K to 100K in CIS, and then go for a pre-seed. But what do I show it in terms of traction? I have interviewed 250 brands, but then I cannot show the trialing on the product, because we try to save money by hiring one developer who was cheap, and then now everything is coupled. Like we have the platform, we have some traction there, but then not as such on like the, you know, the way you want the conversion to be shown on your product. And I'm looking for some money, but then I've already raised some, so it's like a hot situation. And what are we supposed to do?
Yeah, I mean, look, I don't know if you guys have already had the talk from Anthony at Seed Legals, but a kind of a rolling seed round probably makes the most sense, because you can get money in as it comes in, and it's not like you have to kind of you know, Purdy and Amy have probably been to that talk a bunch of times. They know better than I do. You can get money in as it comes in. You don't have to like close it at, you know, a certain amount. It's just like, oh, I've spoken to, you know, X number of investors. It's a rolling close. And, you know, you can use that money as and when you need it, rather than kind of waiting for it to close at once and then, oh, now you can use it. Just, you know, make it rolling, get some money coming in, speak to angel investors, get 10Ks and 20Ks in here, and then you can use them as you go.
As an angel investor, what kind of traction would you look at it at this point, given the fact that you might ask us like where you have, you know, used your 44K or whatever that you had, and we can say that, okay, fine, these are the 1,000 manufacturers and blah, 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 and this is the thing, and we need some more. So is this convincing enough? I really need to understand the matrices that an angel investor would probably look at, because I was sort of in between pitching to VCs, and then I realized that was something which was a disaster, because July and August were again like holidays. Yeah.
What I look for, I mean, to be honest with you, I'm not 100% sure what I look for. Look, 44K is not a lot of money. So the fact that you've done anything with it other than kind of pay yourself and your developer is a result. I wasn't 100% clear about why you couldn't use that to show a bit of traction. And I don't think we have time to cover it all. But you know, show as much as you can show. Right, 44K is not a huge. Nobody's going to expect earth-shattering progress with 44 grand. Okay. Show me what you have done with it, and show me why that is more than anybody else could have done with 44 grand, right? Try and be as scrappy as you can. Imagine somebody had given you 200 grand, what you do with it, and see if you can get to that with the 44 that you've been given, and kind of show investors that you're not frittering away money, that you're actually going to be conservative with their cash. Not too conservative and never grow, but like that you're not just going to throw their money at the wall and you know, lose it. Yeah.
All right.
We'll go on to a question from Hubert. I saw that you put a few questions in the chat, So for the sake of time, let's just go for the first question you wrote down, which was, how can I pull more investors to Ethiopia, and any specific advice? So is there any other details you want to add to that question?
Yes. First, I wanted to say hi to everyone. So this is a new technology that I've been planning to do for the last 3 years. And I spent over $100,000 to develop the applications and then to start the business. It's been 2 years. There's no income. It's all expense. So how can I pull, because all the money that I've been saving, it's almost gone. So how can I pull investors towards to these applications for a little help? Because I know my idea and also this technology will help a lot of people, but there's so many pressure it's coming up. I'm not sure if the comfort zone, it's hard for them to let go, but how can I pull the investors?
I mean, this is like, I'm not gonna lie to you, I know nothing about Ethiopia. And so like, I'm not the best placed person to say this is how you bring investors into Ethiopia. The thing that matters most to investors is, yes, what startups are being built in a country, but also, what is contract law like in that country? Are they going to be exposed for tax liabilities? What does that mean if they invest in a company in that country? So it's almost like governmental rather than purely down to you as one entrepreneur. And so, I know nothing of the legal system of Ethiopia, but they're going to have to sign Ethiopian legal investment documents. They're going to have to wire their money, assumingly, to an Ethiopian bank account. They're going to have to, if anything goes wrong, right? They're going to have to go through Ethiopian courts. They have to trust the law and order backbone of a country in order to invest in any companies there. And I don't know, like, this is me, like, I don't know how big the investment community is in Ethiopia, or whether people are willing to take that risk. If you're looking to bring people over, you need to make sure that that's not a worry for them. You need to be able to relax that for them. It probably realistically is easier, if I'm honest, for you to register as a US company, use something like Stripe Atlas, register as a US company, and then have people be able to invest in the US entity. They'd be much more comfortable with that. Again, this is just me talking to someone who is not familiar with the Ethiopian startup ecosystem. If it's thriving and there's a lot of angel investors, then disregard what I'm saying. But guessing from your question, my hunch is that it isn't. And so, it might be easier, rather than you trying to reform or educate everybody about the Ethiopian legal system, to register via Stripe Atlas as like a US entity, in order to become investable via that method. I think you get a US bank account, you get US documentation. They take companies from all over the world, and it's potentially easier that way than, again, making people comfortable with a system that they're not knowledgeable on.
Great. Should we just jump quickly to Carol, and then we can have a look at the chat again?
Hi, Richard. Hi. Good to see you again. My question is about the pitch deck. So I've been told that actually we should have two. One when we are presenting, to avoid having too much reading over there, and then the other one with all the writing when we are sending them to the investor. I see that you are nodding, so great. I got that correctly. And is there any more differences? What are the differences that you will point out that we should be aware of when with these two types of that we will use our slides? Thank you.
So what it is not necessarily two types of pitch decks, but you should have two types of collateral for one where you send, right? So you can have a one-pager PDF, for example. It doesn't have to be necessarily a pitch deck. I've seen people do Loom videos, right? Where you're kind of going through the product and what you're about, and you can send that. It's just like sending, again, and this comes differently from, like, if it's like a cold outreach, then sending like a small version, a snippet, for example, like a one pager or a video makes sense. If it's an actual investor, and you've been warm introed or you've met them somewhere and they've asked for your full pitch deck, then send them the pitch deck that you would give them. So I think it's different, like marketing collateral for different eventualities, so that if it's a, hey, I wanted to reach out because I've seen you've invested in XYZ. I think it'd be interesting. Here's like a one pager on what we do, highlighting like what you do, your traction, and et cetera, et cetera. And then if they come back to you and say, oh, that's interesting, do you have like a bigger pitch deck? Send them the one pitch deck you have. And so I think that it's so I think it depends on the interaction that you're having, and where
Can I then be more specific? So I pitched the investor and they seem to be interested, and they say, can you please send me a copy of the deck that you just presented? But of course in my deck there was not much writing, so I have two, and that's why I was just wondering if I should maybe add something else to give them extra information.
Yeah, you can do. I mean, I don't think they're going to mark you down for it. Like, don't have too much writing in a pitch deck, right? The images should be able to tell the story ultimately. And so, like I've seen pitch decks where it's like literally all text. You don't want that. You basically want the well-designed images to be able to tell the story. If you need a little bit more context, totally fine. Make it look nice, design it well.
Okay.
Right. And I'm going to answer Audrey's question there about an NDA. Never send an NDA before a pitch, before a deck. It makes you look completely amateurish. The most important thing in this business is execution. Everybody has the same ideas, or 10,000 people have the same idea you have. It's all about execution. I would never take you seriously if you sent me an NDA, nor would I ever sign it, nor would any proper investor.
And then if I may just one quickly, I'm the one who asked about the exit strategy, and I asked because I was asked by an investor. I don't put it on the pitch, but what will be your ideal answer to that question? Because I don't know, I just started. I want to make it big, and then maybe
I'm going to IPO, baby. That's my exit. I'm building this thing to IPO.
We've got 3 minutes left. So can we take the question from Jackie in the chat? So if someone is demonstrating declining CAC, does that make you excited as an investor?
Sure. As long as like the LTV is increasing and the customer acquisition is, like, the number of customers is increasing and the revenues, like, if that is the only metric that is improving, then no, it has to come as like part of a whole story, right? Like, it was like everything else is down, including our CAC. No. But if it's we have figured out a way to reduce the cost of our acquisition whilst also growing our revenue and whilst also growing X, Y, and Z, then great. You found a way to be more efficient. I wouldn't look at it necessarily as super important, but for B2C, it matters more, I think, unless it was like, oh, we used to spend £500 acquiring customers that were going to give us £20 of revenue, and now it's £250. Context matters quite a lot.
Okay, and we've got 2 minutes left. We've got 2 questions. So your name is down as iPhone 2, but if you can keep your question to like 10 seconds or less, and then Richard, your response to 50 seconds or less, we should be able to
talk fast.
Yeah, thanks. Can you hear me?
Yeah.
Yep.
Okay, great. My question is around, I think, a potential opportunity to do like an equity for services swap, which is proposed by an established food and beverage brand. So I'm the founder of an overnight oats company. They're quite established in the industry, and they basically want to offer me access to their team for 2 years, but they would take a share of equity for that. Because I'm a solo founder at the moment, a very small team, so I think they could add value with all the experience that their team has. But I wondered if you've heard of this before, and if you've got any recommendations or cautions to share about making it work.
Yeah, unfortunately, I've usually seen it go badly, if I'm honest. Just because equity should come from cash, and services don't always add up to what the value of our services is £400,000. So it never is, right? That's what they actually might charge their customers, like their other customers at the end. But but it's like talking to a consultant, right? They're charging £350 or £500 an hour. It's not the actual value you're getting from the consultant. That's just what their market rate is, and it's similar for services companies. So if you are going to do it, I would be incredibly strict, not in terms of hours, but in terms of what the actual outcome is going to be from the services that they are providing. Okay. If they say, oh, we're going to provide you 100 hours of developer services, get lost. Show me how much, like how many things you're going to build for me, how many iterations I'm going to get, how many, all that kind of stuff. Give me actual outcomes rather than, hours or value, because I don't agree with the value that you put on your hours.
Yeah, thank you. And then just quickly, if you're raising like over the coming months, but with the SEIS kind of amount increasing to 250,000 from April, would you be happy, like as an investor, for companies to like speak to you now, but say that we're going to like issue the shares in April?
Yeah, I think that's fine. That wouldn't put me off.
Okay.
As long as you actually can deliver on that. Again, that's probably a question better for Anthony from Seed Legals than for me.
Yeah, I was just about to say, there's an article that we can share about how you can do that, but based off of how you phrase that question, you're clearly aware that there are some ways to get around the 250 mark. Okay, so we are at the end of the session. Thank you so much, Richard. I'll say on your point about the 5-year plan and the exit strategy, there are definitely exceptions to this, but Paddy and I have certainly seen that like the good angel investors don't care about a 5-year plan, don't really want to see it, no, it's BS, and don't really want to see an exit plan on the deck. And I would say the newer angel investors still want it. And so, at the end of the day, you have to adjust to get the person's money, shall we say. But it's definitely a sign of a well-seasoned investor when they know 5-year plans are BS. Okay.
I think Yvonne might just be typing up her question because I said that we were going to try and get to it if possible. Sure. If you are, Richard, and you've got like a minute just to stick around.
Yeah, I think it was you guys. You guys have the hard out, right? You got the peer-to-peer at 3. I go forever. I only work for Amazon. It'd be fine if I don't do any work for another hour.
Oh, and after Yvonne,
let me check the share price right now. Still down on the year.
Can you after Yvonne, can you talk about the credits?
Sure. So AWS credits. I'm assuming everybody knows what AWS is for, why you use it. It's the infrastructure layer underneath the app or the mobile app or the web app or the website, whatever that you build for compute power or storage or whatever. We have an Activate program, which provides you credits, which means that you don't have to pay for the first, I think it's $10,000 through Hotbed that you use. And just, Purdy and MA have the code, sign up. Don't sign up unless you're actually going to be using AWS, because the credits have a 2-year lifetime. And so they will start to tick, or the 2 years will tick away if you're not building yet. It is fine. We don't have you have to use it now. Use it when it's most valuable to you. Okay. The other thing is you will be able to get top-ups kind of as you grow. So you get 10 grand from Hotbed, but you get a little bit more when you get that seed funding, or kind of to your Series A. To every startup is allowed 100K of credits in their lifetime, but you can take it in stages. Don't use it all up in one go unless you're doing some crazy heavy machine learning workloads and utilizing a bunch of GPUs. Just only use it when you need it, or only apply for it when you need it, because that countdown starts the second they're in your account. If
people have already had AWS credits from somewhere previously, what can they do with the Hotbed credits? I think that's two questions that have been the same. Yeah, so if you've had the 10K that Hotbed offers, unfortunately, you won't be able to get more until you've raised something maybe from a seed fund or an angel that's affiliated with Activate. So it comes in stages, but so you can get, it's provided like maybe you get 10K at the very early stage, you get a top up to 25K once you've raised that seed funding, and then you can get that 75K final top up once you kind of get to your Series A or kind of your seed plus stage. It's designed that way so that you don't overindulge credits, because what used to happen a lot is people applied for a lot of credits and they're issued on a use them or lose them basis, right? So what used to happen a lot is people would apply, they'd get 100 grand or 25 grand, and then they didn't use them, and then they'd come to us and they'd be like, oh, I only used 3 grand of the 100K, can I get my 97 back? And we'd be like, no, because the Activate team based in Seattle is very mean and they will not allow it. And so we're trying to make sure that you get the best out of the credit program. We will send out an email, but there's also details on our platform about what Activate actually is, and you can check out the website. So for anyone that's not familiar with it or has more questions, we will answer those for you. And we've got some one-to-ones with the AWS team in a few weeks anyway, so that you can book in a slot. If you've got any specific questions, you can just have a one-to-one and use that time to talk about your situation. So we'll send you details of that as well.
Do you want me to answer Yvonne's question?
Very quickly, if you can.
What minimum traction are you as an angel investor comfortable with if the founder is knowledgeable about their market? It totally depends on the market and what you're building in. Is it B2B? Is it B2C? Is it enterprise? Knowledge of a market does not mean that you can sell. And so what traction really is proof and evidence that you can sell and that there's actually a problem that you are fixing. And so knowledge itself does not cover that. Because, you know, I'm super knowledgeable about the startup market, but it does not mean that I can necessarily sell to startups. And so it really matters to me that you are able to sell, because again, that is how this company is going to make money. And it's going to be valuable, and it's how it's going to return money to me as an investor.
All right, perfect. Thank you. Okay, everyone, wave Richard goodbye. Where can people find out more? Is the best place to direct people to your Twitter, LinkedIn?
Yeah, follow me on Twitter for my pithy tweets, and you know, the multiple thousands of people that I will be buying to engage. I think it's @_R_Howard. A lot of startup tweets, and feel free to just ping me. Also, LinkedIn is a bad place to message me because I barely ever respond. Twitter or email is probably the best.
Cool. Sounds good. Thank you so much.
Thanks, guys. Thank you for having me.